Hello there, welcome to Market Call. I'm Andrew Bell. Thank you very much for tuning in. Teal Linde is on our show today. He is manager at Linde Equity Fund, and he'll be taking your questions on North American mid and large cap stocks. You can call him toll free 1-855-326-6266 or email us right now, Market Call at bnnbloomberg.ca. Teal, thanks very much indeed for joining us.
Thanks for having me.
Maybe we could put up a 10-year or 20-year chart for the S&P 500. You say going back to 1968, there have been three major peaks in the U.S. market. Tell us what your thinking is. What was significant about those?
Yes, I'm just thought I'd draw attention to how the U.S. market appears to be becoming an overcrowded trade, and you can measure overcrowdedness by the percentage of U.S. households of what they have of financial assets in the stock market. And historically, when you've had peaks of high ownership, it's often coincided with peaks in the stock market tops. And if you go back over the last 60 years, in the late 60s, around 1968, ownership got up to about 28%. So U.S. households had 28% of their financial assets invested in the stock market. And that coincided with the market top with the big bull market of the 1960s. And then the market fell about 50% soon after that with the collapse of the Nifty 50. And then you go to 2000, ownership got up to about 25%. And again, the market fell roughly 50%. And so today, the most recent stat is that U.S. household ownership of stocks is now about 30%. And you can compound that with foreign investors also owning more U.S. stocks than they've ever had before.
I thought there was this sell the U.S. thing going on. Foreigners have been divesting U.S. assets.
That's a good point. Actually, the 30% stat, when I said it's the most recent stat that I've seen, it was as of the end of 2024.
Oh, okay.
And so you are correct. This year, so far this year, there has been somewhat of an exodus and a migration to more foreign equity markets. So the 30% was really just half a year ago.
Now, you have an ominous note here. You say, as U.S. stocks have reached peak popularity, historical evidence suggests that whenever the S&P 500 reaches its current valuation, the forward 10-year annualized return has averaged around zero. So people have had a dead decade after seeing valuations like this.
That's right. If you go back over time and look at when the market's been, or the S&P 500 valuations at its current level, that has historically been the return on average. And some people might think, well, it's hard to imagine that happening. And yet, if you look at the 1990s, that was another roaring decade. But the decade following that, the S&P 500 declined 23% over a 10-year period. So that's losing losing about 2% a year. So it can happen. Now, I guess the only argument to suggest that the markets could stay higher and that you cannot compare to past cycles is that U.S. tech stocks have become a much larger portion of the S&P 500, and tech stocks, NASDAQ stocks, historically have traded at higher valuations. So that may be the one reason why history may not repeat. But nonetheless, when you consider the high ownership of the crowded trade, foreigners, U.S. investors, the historical valuations, investors should become more vigilant in what they own, and they should be looking through their portfolio and identifying what stocks where the fundamentals justify where they're trading at, and which stocks may be far ahead of themselves and adjust accordingly.
Teal, we're looking forward to having you on the show. Teal Linde of Linde Equity Fund, taking your questions on North American mid and large cap stocks. We'll be right back. We'll kick off here with an email from Jay. Of all the U.S. banks, would Citi be the one you'd be considering?
All right. No, Citibank or Citigroup would not be the one I'd be considering today. I mean, if you go back to 2008, Bear Stearns disappeared, Lehman Brothers went bankrupt, And the next bank that was about to fall, if there would have been a large U.S. bank, would have been Citigroup. And the only reason why it didn't was that they got a major bailout by the U.S. government. That's when the whole concept of too big to fail really sort of became a topic of conversation. And since then, Citigroup has been making a large effort, ongoing effort to improve their operations. But they're still one of the less profitable banks of the major banks out there. And one of the main reasons is that it's a very international bank, similar to Bank of Nova Scotia. And so they're kind of spread themselves thin. And when you want to succeed as a bank, you really want scale. And so you really sort of want to dominate the markets that you're in. And when you're sort of spread across the globe, it's harder to do that. And so a bank that has much more success in scaling is JP Morgan. I mean, they focus on dominating continental USA, where they enjoy having many touch points with their customers, which makes the relationships more profitable and also makes the relationships more sticky. So if there was a U.S. bank that I'd be considering buying or looking at, it would be JP Morgan.
JP Morgan to be your preference. Let's head to London, Ontario. We've got John on the line. Go ahead, John, please.
Hi, Andrew. Hello, Teal. Teal, I wonder if a component of that capital allotment peak of 30% has to do with baby boomers who are debt-free, and they're reinvesting their investment income in the equity markets, accounting for some of that peak. I hope that's true. Teal, my question is on private equity capital managers such as KKR. You like Blue Owl Equity. I think that was your top pick a while back. Do you still like Blue Owl, or should I take my money someplace greener? Thanks very much.
So it's an asset manager, Teal, and it does, is it private lending?
It does private lending, yes. So yeah, thanks for your call on Blue Owl. We still own it and we still like it. And it's an alternative investment manager. You can consider KKR or Brookfield in there. And I guess one of the reasons why we like Blue Owl is it's a newer company. And because it's newer, the valuation's lower than its peers. And because it's smaller than some of these larger companies, it's actually growing faster than its peers. So it's an example of a company that's growing faster and at a lower, more attractive valuation. And it's pulled back recently along with all the alternative investors managers because starting from November, December, January, there was a lot of optimism with the stock market and the new Trump administration. And so that was going to encourage a lot more sort of transaction activity, which would be good for these companies. But then with the tariff uncertainty, the tide has turned, and so the sentiment has dragged all these alternative investment managers down. But Blue Owl is somewhat different from the others in that it has a very, very high proportion of permanent capital. And when you have permanent capital, the earning stream is more predictable. And so back in February, they had their investor day, and they anticipated that they'd have a 25% year of growth of fee-rated earnings this year and 20% over the next 5 years. And that's, again, that was when sentiment was better. So perhaps it comes off a bit, but even if it's at 15% or double digits, it's still an attractive growth profile for the stock.
Okay, thanks for that question. Let's head to Edmonton. Terry, go ahead, please.
Yeah, I think you answered my question in your preface, but I was just asking if there's a 10% pullback in TSX this year since it's hitting all-time highs. Thank you very much.
Thanks.
All right, thanks for your call. Well, 10% pullbacks, they're hard to predict. They can happen on any moment depending on what goes on, but I could probably share a stat that, and this is really with the S&P 500s, but often the markets sort of correlate, other markets correlate with it, but typically over the last 70 years, you've had a 10% decline from peak, well, from its most recent peak, on average about once every 2 years. And so I can throw in some other stats. A 5% decline happens on average once every 7 months. And a 20% decline happens once every 4 to 5 years. So you could have, we just had a 10% or 19% decline in the S&P 500 just recently. So perhaps we've got a ways before the next one happens. But I would suggest that, in my comment earlier, I suggested that the markets are more expensive now, and you can't suggest that, well, they've got to revert back to the mean because the markets today have a lot more tech stocks and NASDAQ stocks dominating the S&P 500. And so that's a positive for why to justify or holding up the valuation of the market. However, NASDAQ stocks and tech stocks are more volatile. So the idea that 10% pullbacks happen once every 2 years over the last 70 years. I would suggest that they're probably going to happen more frequently, just simply because the makeup and the mix of the S&P 500 contains more tech stocks, which tend to be more volatile.
Okay, thanks for that question, Terry. Let's head to Montreal. Joe, go ahead, please.
Thank you, Andy. I want to ask Teal about TD Bank. Retired it in my cash account, and it's done quite nicely over the last few months, bounding back after the U.S. Fines that they had to endure. And I wanted Teal's outlook for the bank in the next 3 to 5 years, and if he does he have a target price for it? Thank you.
All right, thanks for your call. TD Bank's had a fabulous run. It's amazing how quickly it got out of the penalty box. I mean, last year the stock was in $75 to $80, and people figured it was going to be stuck there for quite a while because of the cap on its assets in the U.S. And yet, I think it's up about 27% year to date. It's the best performing Canadian bank stock so far this year, and all the banks have kind of run back up after the March-April sell-off. And so in terms of the next 3 to 5 return expectation, I think generally speaking, you can probably count on a 5 to 7% share price appreciation and a 3 to 4% dividend yield on top, so 10, 11% total return. It's hard to pinpoint exactly how each year is going to be, but the banks have been successful in sort of delivering those types of returns, sort of a high single digit add on to dividend, and you can probably get to 10, 11% total return.
Okay, thanks very much for that question. We're going to be back with Teal Linde of Linde Equity Fund. The topic, North American mid and large cap stocks. The number 1-855-326-6266. We have an email here from Chelsea. Would you buy Couche-Tard right now? Do you think they'll be able to see that deal through, the giant acquisition of the parent of 7-Eleven?
All right. Well, thanks for your email, Chelsea. I guess I'd rate Couche-Tard a buy at this current price level, simply because the uncertainty of the intended acquisition is weighing on the stock. And I think either way, you can argue that there's upside. I mean, if the deal doesn't happen, then that relieves the weight on the stock, where there's a concern that it might be too dilutive. They might have to issue a lot of stock, and so if it doesn't happen, then that worry goes away. And if they do succeed, it does look like there'd be a lot of quite an accretive acquisition, because it does seem that the stores that Seven and I have are underperforming relative to what the stores are at Couche-Tard are. And so if they were able to take over that company, I think there would be quite a bit of upside in improving the profitability of those companies. Now, in terms of whether the deal is likely to go through, I mean, Couche-Tard has tried to make large acquisitions in the past, like Carrefour out of France, Speedway and Caltex in the United States, and they didn't happen. And so it's not a sure thing. And Seven & I is based in Japan. And Japan's a very insular, sort of protective nation, and they don't like foreigners meddling in their affairs, let alone buying one of their iconic companies. So I would suggest it's still an uphill battle.
Okay. And sorry, just clarify, say it doesn't go through. Is Couche-Tard a buy? Yeah,
Couche-Tard, if it doesn't go through, then the company can get back to focusing on smaller deals, and then it won't have to issue any equity, and it could focus on organic growth, which some people believe is being they're being distracted from because of this acquisition attempt. And then it can return capital to shareholders. What would be interesting, though, is if they tried and successfully acquired the U.S. stores that Seven and I have, and because in that would sort of remove the risk of they wouldn't have to issue as much or any stock. There'd be more conviction in the synergies. There'd be less integration risk. And then Couche-Tard, which is on this mandate to increase sale of fresh foods. 7-Eleven has a lot of commissaries throughout North America or in the U.S., and that could provide a source of more food products for their existing stores.
Okay. Kirk in Calgary, go ahead, please.
Hey, afternoon, guys, or good morning, I guess, still for me. But anyways, just wanted your thoughts on Suncor. I know a lot of folks tend to favor CNQ over Suncor, but I'm wondering why that is. I find Suncor's firing on all cylinders here, and just your thoughts on Suncor and where you see it.
Thanks.
Thanks for your call. I was actually having that sort of internal debate in my mind as well, which would I prefer, buying CNQ or Suncor. And Suncor has had 6 consecutive quarters now of really strong results, beating expectations, and they've really turned around the organization, both financially and culturally. And so there's starting to be some discussion, is there still room for improvement further? Now, management says they do see room for further gains or improvement over the next couple of years. But the fact that question is being raised makes you wonder. And so with CNQ, CNQ has a stronger history of growth. And Suncor really has sort of been a turnaround success story in the last year and a half to 2 years. And yet CNQ has continued to grow. And I think longer term, I would probably prefer owning CNQ because of its history of growth, but also it's got a 5% dividend, which is, I believe, higher than what CNQ is. And so when these large companies are not growing as quickly as they used to when they're smaller, so if you have a rich dividend in one of them, that's quite attractive. And CNQ, I mean, they've been raising their dividend now for 25 consecutive years in a row. And so I know some oil and gas companies like to have a dividend and have special dividends, but they put it all out there each year, and it seems like you can count on it. So 5% for CNQ as a dividend yield, plus the growth profile on top.
Thomas in Cornwall, Ontario. Go ahead, please.
Hi, Andrew. Hi, Teal. Teal, my call is about TELUS Digital, or formerly TELUS International. Mm-hmm. What would be your comments to someone who owns shares, and with regards to the share, plunge off a cliff, and TELUS Corporation's intentions to take ownership back? Mm-hmm.
Yeah, sorry, I missed the question on that. TELUS International,
Yeah, well, as you know, TELUS is offering a buyout to buy out the other shareholders. What would your strategy be if you held TELUS International, the affiliate?
Well, I think that it's interesting. They owned the whole company. Then they they listed it, and then the stock falls, I think, 90% from where they listed it, and then they buy it back. So I guess they're getting a deal when they're buying it back at 90% of what they sold some of the shares back for. And so I think that if you're getting, you can hold it till it gets, I mean, it looks like it's gonna go through. I don't think there's any competition. They already control the company, so it's not going to be difficult for someone else to come in and buy it. And so I think you can just take your profit now, or just wait for the deal to close and maybe get a little bit more there. But I think it's interesting as to wonder why they're doing this. And I think what I've read is that they have other businesses that they want to bring public. And when your track record is of bringing a company public and it's dropped 90% in value, it makes people wonder whether they should participate in the next offering. So I think it might be that they want to sort of take it off the market and put it behind them, or no longer just have it out there as a reference point, and allow them to go on with their TELUS Health or TELUS Agriculture or some of the other businesses that they have, which they're considering to list as well.
Okay. Louis in Toronto, go ahead, please.
Hey, Teal, question about Ensign Energy, ESI. I just wonder where you see that going, and 40% owned by Fairfax and Murray Edwards. Seems to be really undervalued. They've paid back so much debt in the last few years. What are your thoughts on this?
Ensign Energy.
Yes, they've been on a 3-year program to pay down $600 million worth of debt, and this is the 3rd year, and they have to pay down another $158 million in the 2nd, 3rd, and 4th quarter. And oil prices have come off, and there is some concern whether or not they're going to be able to do it. But management still feel comfortable they're going to meet that target. They say they do have flexibility on their capital spend if they need to increase their free cash flow that way. And they've also said that their banking syndicate is very supportive. And so the caller is correct. There's a lot of insider ownership. I know that the CEO and the CFO both bought collectively $250,000 worth of stock just this quarter. So despite the concerns and the stock being down, they continue to be believers. And I would say that there hasn't been a lot of insider buying in the markets in the last few months, despite the sell-off in March and April. So any kind of insider buying is a strong indication. And so I think what'll be interesting is once they finished meeting their debt the debt pay down requirements, they'll have all this free cash flow which they can use for other purposes, whether it's to buy back stock or reinstate a dividend. If they were to reinstate the dividend that they used to have throughout most of the last decade, you'd have a dividend yield of between 15 to 20%. And the stock certainly wouldn't be sitting where it's at if that were to happen.
Okay. Thanks for that question, Louis. We're going to take a quick break. When we return, we'll check out Teal's past picks. Teal was on our show June 17th of last year. Or was it this? No, last year, wasn't it? 2024. Yeah. I'm sorry. I haven't had enough coffee today, Teal. Brookfield Corp was your first idea, Teal. Nice gain, 45%.
Yes, Brookfield Corp, if you go back a year ago, it was trading at a really sharp discount to its net asset value. I mean, Brookfield, as you know, it has ownerships and stakes in 4 publicly traded subsidiaries: Brookfield Asset Management, Brookfield Renewable Partners, Brookfield Infrastructure Partners, and Brookfield Business Partners. And if you were to add up a year ago, if you were to add up the value of those stakes, it was equal to what the market cap of the company was. And so that meant you got all their commercial real estate, their privately held holdings, their commercial real estate, and their insurance business for free. And so over the last year, you've seen that gap close. Now, that wasn't the only reason why I recommended the stock. I mean, as of last year, the prior 10-year return to shareholders was about 15% on an annualized basis. And then last fall, they announced, or they forecasted, they expect core distributed earnings to grow at a 17% compound annual rate over the next 5 years. So if they were to achieve that or come close to that, and the share price were to follow, it'd be an attractive return for shareholders.
Okay. And so, sorry, give us that again. Would you put new money into Brookfield right now, Teal?
Yeah, if you don't own any, I think it's a company that you do want to own long term. So you can start accumulating a position. You can start that today, or you can wait for a pullback. But it's been a very long-term success story, and they still, despite the size of the company, they're using scale to their advantage to propel further growth going forward. So I don't think the run is done with Brookfield.
Your next idea was an outfit called Kinsale Capital, KNSL, in New York. This one up more than 20%.
Yeah, same sort of thing here too as well. I mean, last year, it wasn't, I wouldn't say it was trading at a discount, but it's a company that's always traded at a premium. And it took a large sell-off because results hadn't met expectations. And so the premium was collapsed. And so it was recommended. And then, so obviously now it's reverted back to its typical premium valuation. And the reason why this company typically trades at a premium is that it's a specialty insurer that is highly profitable, growing at 15 to 20% historically. And they have about less than 2% market share. And their playbook is to emulate the success of 2 other insurance companies, Geico and Progressive. They're both auto insurance, but those companies also were low-cost providers that leverage technology to grow rapidly over time. And Kinsale that's what they would like to do as well, except rather than being into auto insurance, they're into specialty insurance. And
then finally, this was perhaps a counterintuitive one. Well, I guess last June, we didn't know about the tariff, the trade war, but Linamar, and this stock down over the period.
Yes, Linamar is one that we've, after many years of supporting it and believing it, the company is a great company, it's well managed, but it just never got this respect from the market. And I just think that it's becoming more challenging when you have all this tariff uncertainty, even though they are sort of protected under the U.S., Mexico, Canada trade agreement. That comes up for renewal next year. You really don't know what's going to happen to that. And I mean, even when things were going well, like last year, and Linamar had a great year last year, but it hardly moved the stock. And so we've decided to move on from it. And in terms of vehicle transportation exposure, we own BYD and Uber, and enjoying that and having more success with those 2 companies and stocks.
Okay, so you're in BYD. You see their dominance continuing in electric vehicles still?
Yeah, it's phenomenal what some of the advances that they're making. I mean, they've got a new charging system that they're rolling out in their sedans and SUVs that can provide 400 kilometers of distance and on a 5-minute charge. I mean, that's becoming close to parity with the time it takes to fill up a tank of gas.
Yeah, that's right. But we can't buy them here in North America anyway.
No, you can't. And that's another thing. I mean, if you look at these auto companies that are selling across the outside of North America, BYD is selling to nations throughout the world, including Europe. And they are more affordable, which is why the United States and Canada have 100% tariffs for them, basically to protect the domestic industries.
Teal, thank you very much. Great to have you here. After this, Teal returns. Teal Linde answering your questions on North American mid and large cap stocks. Let's head to Vancouver. Moez is on the line. Go ahead, please.
Good morning, gentlemen. My question is on TC Energy. Does it have more room to run up? Thank you.
Thank you.
All right, Moez, thanks for your call. TC Energy is one that we've owned for a while, and it's had a large run up in the last year. And I remember last year I've been on Market Call talking about how it's got a lot of insider buying across the executive suite, and now you got a lot of insider selling over the last little while. I mean, it's really run up over the last year, and so I would take that as an indication that most of the run is done. I don't think there is as much upside. There could be a little. There could be maybe into the low 70s, but for the most part, the big gains are done on this one for a while. And if historically this is a stock that does have pretty large swings over time, and it's a pipeline business, you think it'd be pretty stable, but it is sensitive to changes in expectations of interest rates, and you never know where that's going to go, and that actually has a pretty large impact on the stock price of companies like TC Energy.
Let's head to London, Ontario again. Lawrence, go ahead, please.
Good afternoon. Thank you for your past suggestions. I'm wondering if I should buy TFII or another transportation company, please.
All right, thanks for your call. Yes, TFI International has really come off a lot since last year, and I mean, this is one that we look at, and I believe you could justify opening a position. It's always difficult to know exactly when to buy a company that's going to turn around, because if you wait for the results to get better, the stock is invariably higher, and yet it could go lower because you just don't know that either. So it's probably best to sort of stagger dollar cost average yourself into a turnaround stock. And so I think, considering that the balance sheet's healthy, it's generating a lot of free cash flow, this company, it's not a question of whether it's going to survive or not. It really is a matter of when's it going to turn around. And that's going to be predicated really on when the industry turns around. And again, once there's signs of things turning around in the industry, the stock is probably going to run up quite a bit. So you could probably justify starting to accumulate now.
Okay. We've got Nazar in Scarborough, Ontario. Go ahead, Nazar, please.
Oh, hi, Andy. Hi, Teal. May I have your thoughts on Air Canada, please? This has been your pick in recent days. The stock price recovered from $14 to around $19, where it has stalled. Do you see this will have the competition that will be coming in the domestic flights will have on Air Canada going forward? Thanks for taking my call.
All right. So thanks for your call. I guess your last comment about domestic or foreign competition coming to Canada, if that were to happen, it would take a while. And Air Canada is meant, and we own Air Canada, but we see it more as a trading opportunity rather than a long-term growth opportunity. So by the time, if foreign competition was to arrive in Canada, it's our hope that we have already exited and made our profit on Air Canada at that point before that happens. And with respect to the trading opportunity, I do believe that Air Canada still has upside. And you can tell just by how enthusiastic management is on buying stock. I mean, you've had starting last November, the company announced their normal course issuer bid, where they plan to buy back 10% of their shares outstanding. They started doing that when the stock was around $24, and they wrapped that up in a few months. And then and then when the tariff uncertainty came, Air Canada stock started declining, and you had insider buying in March across the executive suite, most of the executive suite, and directors. And then you had they issued a boatload of stock options around $17 in early March. And then most recently, they've announced a substantial issuer bid, which is like a Dutch auction, where they've announced they want to buy $500 million worth of stock. And a substantial issuer bid is different from a normal course issuer bid. A normal course NCIB, you give yourself 12 months to buy the stock. And even though Air Canada completed that in a matter of, I think, about 4 months, a substantial issuer bid is where you want to take advantage of the low price. And so they want to buy $500 million worth of stock, which is going to be about probably 8%. So over the last, if they complete that and they have the NCIB done, that's about 17, 18% of shares that have been bought and canceled in less than a year. And not only is that a sign of bullishness that management has on the stock, it reduces the share count by that much. So the revenues and earnings per share are going to go up proportionally. So we think it's attractive. I think Air Canada is trading below its historical valuations and even a greater discount to the valuations of its American peers.
Okay. We've got an email from Terry. Can you give us your updated thoughts on Five Below, that discount retailer in the U.S.?
Yes. Five Below, they recently announced results that were quite a bit stronger than expected, 19.5% revenue growth over the previous year, and same-store sales are up 7%. They've also announced that their co-founder CEO is stepping down, and I think that's another positive. I mean, it was on his watch that the things started to unravel 1 to 2 years ago, and so new management has been in place over the last year, and they have been doing a good job. So with the co-founder CEO stepping down, I think that's going to give even a freer hand for the current management team to continue the changes they're doing. And then lastly, they've announced a partnership with Uber, and so you now can, in the United States, you can buy Five Below products on Uber Eats, which I think makes it quite competitive, probably more competitive than buying similar type products on Amazon, because if you buy it on through Uber, you'll have not only a more curated selection. Like if you go on Amazon, you're looking for something that Five Below has, you probably get like 10 to 15 different versions of the thing you're looking for, and you spend a lot of time deciding which one you're going to buy. Mm-hmm. If you're able to buy from Five Below, they've already made that merchandising decision, and they filtered it down. And of course, if you buy it through Five Below and Uber, you're going to get delivery probably a lot faster than having to wait through Amazon, even if it's a day or two. But with Uber, you should be able to get your product within an hour.
Okay. Interesting that, taking on the mighty Amazon. We're going to be back with Teal Linde. He's taking your questions on North American mid and large cap stocks. Let's have a very quick look at oil here, because there is a report from the Wall Street Journal, and you can see oil. Yeah, oil was, it's still down, volatile. It did blip up briefly. Anyway, the Wall Street Journal is saying that Iran has been moving missiles in preparation, or moving launchers in preparation for a possible attack on U.S. forces. But it looks like the oil market taking it in stride right now. Oil still down more than 2%, but we're going to be watching that one. Let's get back to the questions for Teal Linde. Vicky has sent an email. Can I get Teal's thoughts on restaurant brands?
Yes. Okay. Thanks for your email, Vicky. Restaurants, brands, international, is a buy, hold, or sell? I would go with a buy. It's pulled back recently, and the main reason I think is that how incentivized the executive chairman is on getting the stock price up, because the individual, he used to be the CEO of Domino's Pizza, where he had 27 or 29 consecutive quarters in a row of increasing same-store sales, and he really was successful in digitizing the customer experience at Domino's. And so Restaurant Brands International brought him over, and as part of the deal was that he was required to buy $30 million worth of Restaurant Brands International stock with his own money, right? And in return, he got a compensation package that would reward him up to $200 million in compensation if he were able to basically get the stock up over 5 years at 10%, 10% a year for 5 years. And so since when I think he started in late November, the stock hasn't moved up that much, so it's sort of below plan. And so considering his success at Domino's and the incentivized package or compensation package, I suspect that in the next couple of years that he's got left on that 5-year plan, that we'll probably see some upside in the stock from where it's trading at today.
Okay. We have Gulam in Toronto. Go ahead, please.
Hi, good afternoon. My question is on International Forest Products. I bought this stock years and years ago, and it's just been sitting there for a while. I think it's got some profits in it. My question is, should I sell it and take a little bit of profit, or you see much upside in the next year or two? Thank you for your response.
Okay, thanks for your call. Well, whether you take profit on it, I think it depends on how much, what weighting it is in your current portfolio. So that would be something you'd have to decide personally, what you're comfortable with. But in terms of the outlook for the stock, Interfor is interesting. We do like to follow it because it's a pure play lumber producer, unlike, let's say, Canfor, which does have some exposure to pulp and paper through its Canfor Pulp and West Fraser. And so right now the forest stocks are down because the housing market in the United States is quite weak. And so I think what'll turn it around, if interest rates in the U.S. were to finally come down, that would spur more activity in the construction and the housing market, which would probably provide a lift for lumber companies. And another thing with Interfor is interesting to consider is that 60% of the lumber that they manufacture and sell is based in the United States. It's only 25% of the production from Canada of their production is actually manufacturing sold from Canada, the United States. And so it makes you wonder, like if the tariffs go in and U.S. lumber producers are able to sell their lumber to home builders at much higher prices, the Canadian lumber producers have actually invested a lot and have a lot of capacity and production in the United States. So it's a question of whether the gains that they're going to get from higher lumber prices in the U.S. because of tariffs are going to more than offset what they give up in Canada. And so we don't own Interfor. We've owned it in the past, and it is one that we keep our eye on. If we believe that there's going to be interest rates are coming down and there's going to be a lift in the housing market, it would be one of the stocks to consider owning. So I would, if you've already got some shares and you've made some money on it, I wouldn't sell them all. I would keep all or at least some of those shares going forward.
Let's go to the emails. Melissa is asking, what's the outlook for Shopify?
Shopify is continuing to grow at about a 20% rate, 22%. I mean, they're focusing on their enterprise, which is difficult because Shopify was always sold out as your one-stop shop. And for startups, does everything for you. But large enterprises, they typically have different software for different purposes from different vendors. And so that's a little of a tougher sell. And then they have their international expansion, which they're succeeding at. And then they have their point of sale business, which is where they're getting customers where they don't even have an e-commerce relationship with. But the outlook of the company is positive, but the outlook of the share price is probably a little different because it's trading around 100 times earnings. And so a company that's growing 20%, you're going to trade at a premium, but I think 100 times earnings is probably too rich of a premium. And so there's valuation risk there where perhaps if the company's growth rate was to slow down, then that PE multiple will most likely contract and you'll end up either in a sideways or slightly down position over that period.
Okay, so nice company, not so much the stock. Okay, we are out of time on for calls with Teal. Time always goes so fast. We always learn stuff from Teal Linde. Next, we're going to get his top picks. Join us tomorrow on Market Call. Our guest is Keith Richards, President and Chief Portfolio Manager at Value Trend Wealth Management. And Keith will be taking your questions on technical analysis. And if you miss Market Call, as if that could ever happen, check out our daily podcast. You can find it on iHeartRadio and other platforms. And you can watch full episodes on our YouTube channel. Let's get to the top picks. Pembina Pipeline is Teal's first idea.
Yes, Pembina is the third largest midstreamer in Canada after Enbridge and TC Energy. And we actually own all three. But right now, I think the one that's most attractive for purchasing would be Pembina. And so Pembina it's got the largest infrastructure in the Montney region, the natural gas rich Montney region. So it's well positioned to benefit from the anticipated increase of LNG exports off the BC coast. It's got a healthier balance sheet than both TC Energy and Enbridge, and it's got a dividend payout ratio that's actually more conservative than its larger peers, which will allow it greater advantage of being able to fund its growth pipeline through the rest of the decades without having to issue any equity. And then of course it's got a 5.5% dividend yield as well. And so TC Energy and Enbridge have both run up a lot over the last year, and yet Pembina isn't much higher than where it was 12 months ago. So we think it's an attractive entry point today.
Okay. Your next idea, Delta Airlines. You're not worried about consumers cutting back on travel?
Well, that's a good point. It's certain consumers are cutting back, and it's the more price-sensitive consumers. But consumers that want to travel international or have the means for traveling international are traveling international. And consumers that like the premium seats. What's interesting is that if you look at the airline sector, corporate travel has come off a bit because of the uncertainty. Price-sensitive consumers have come off a bit, but international demand is still strong, and demand for premium seats is also still healthy. And so what gives the advantage to Delta is that even though its stock is down with all the other airlines, it has the highest portion of seats revenue that's generated from premium seats. They expect by 2027, more than half the revenues are going to be coming from the sale of premium seats instead of the economy class or main cabin. In fact, 85% of new seats that they're installing into their planes or capacity are premium seats. And so it's trading around 7 times earnings. Before the pandemic, it was trading around 9 times earnings. And it was around 9 times earnings early this year, but then with all the tariff uncertainty, it's brought back down to 7. And I think as an industry leader, I think the stock should be at least at 9 times earnings. So that's anticipation over the next year.
And I mean, obviously, airlines, economically sensitive, business travel, consumer travel is going to be influenced. So does your model include a recession in America because of the trade war?
No, it doesn't. It just the model really, the economy is really becoming bifurcated, where you've got people that own stocks and own assets, stocks and real estate, and they've been doing fine, right? They've seen the appreciation for the real estate and their stocks are doing, and then there's people that depend solely on wages. They're not doing as well. And so you're seeing that with different companies that are catering to those two segments. And in fact, you're seeing more premiumization occurring now in the marketplace, where more companies are now coming out with products that are more premium, higher priced, because there's so much demand from that clientele that own assets. Which is interesting because as companies start creating more premiumized products, the price is going to go up. Which their customers can afford, but it's actually going to have an upward tick on inflation. And so Delta Airlines is considered to be, of all the airlines, one that caters more to the premium customer. And so from that respect, we're comfortable with it, despite recessionary risks.
We're a little tight for time. UiPath, it is an AI play, but it's in this agentic AI, which is a far more independent form that can learn from its interactions.
Yes, agentic AI, it's more autonomous, be able to analyze, decide, and act on its own, in contrast to generative AI, where you got to provide prompts. And so UiPath is the industry leader in robotic process automation, where they relies on very rules-based, structured environments. And so agentic AI, where basically it's going to emulate the human mind, it's going to allow it to do more unstructured, more complicated works. And because UiPath has 10,000 customers for the robotic process automation, they're in a very strong position to start introducing their agentic AI solutions to their customer base. Analysts have generally a hold rating on the stock because they want to see more traction. But by the time the traction occurs, the stock will be up. So we're getting in there earlier on, anticipating that that's what's going to happen.
It's quite the area, all right. The agentic AI, and we do hear these social warnings that this thing is already out of control. Teal, we better leave it there. Thank you very much indeed. We always, as I said, learn a lot from you. Teal Linde has been our guest on Market Call. Thank you very much indeed for watching. Remember, Keith Richards is coming up tomorrow. You can email your questions for Keith right now to marketcall@bnnbloomberg.ca. Have a great day in the markets.